Hi everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for VettaFi. Today, we're going to look at the current state of the housing market. There's a lot of talk about rising prices, interest rates, tariffs, and overall uncertainty. So let's cut through the noise and look at key housing indicators that are shaping the market right now. But first, I want to take a moment to talk to you about Exchange. Exchange is a financial services conference for advisors to strengthen their skills and develop across core dimensions of their professional portfolio. I hope you stay tuned after the video to learn more about this exciting conference. Now, back to the charts. Let's dive in. Let's start with a crucial factor, mortgage rates. This chart here shows the 30-year fixed mortgage rate according to Freddie Mac. As you can see, rates rapidly increased from the record low in 2021 and have been sitting above 6% for nearly 2.5 years. This significantly impacts affordability and has discouraged many potential homebuyers, both those looking to enter the housing market and those looking to sell their current home for a new one, but are reluctant to give up their current rate. The federal funds rate influences the cost of borrowing for banks, and when the Fed increases this rate, banks often raise their lending rates, which can then impact mortgage rates, among other things. A rising Fed funds rate generally leads to higher mortgage rates and vice versa. Although this was not the case recently, when the Fed began their rate cutting cycle last September, and mortgage rates moved in the opposite direction. With that said, mortgage rates have recently been on the decline while the Fed has held rates steady. So what will the rest of 2025 bring? Right now, markets are pricing in 2, possibly 3 rate cuts this year. So we might see mortgage rates continue to slowly come down. But then again, as we're seeing right now, this is no guarantee. Now let's look at pending home sales. This gives us a forward-looking indicator and can be a leading indicator of the future sales activity because it shows contracts that have been signed but haven't closed yet. Pending home sales have declined for most of the past 3 years and recently hit their lowest level on record. The current high interest rate environment has led to increased monthly mortgage payments, making homes less affordable. This directly impacts pending home sales as fewer people are able or willing to sign contracts. Now let's move on to existing home sales. This chart shows the number of previously owned homes that have been sold. As you can see, sales have struggled over the past 3 years, but did show some improvement at the end of 2024. As I mentioned earlier, affordability issues have kept many potential home buyers on the sideline over the past few years. Now let's look at new home sales. This reflects the number of newly constructed homes that have been sold. New home sales have showed mild growth since the start of 2023 and are currently at pre-pandemic levels. While affordability is still an issue, the lack of existing homes has caused those home buyers not on the sideline, who may have accepted this new reality of 6% or higher mortgage rates, to turn to new construction. And to understand the supply side, let's look at housing starts and building permits. Building permits are like the blueprints, indicating planned construction, while housing starts are the actual construction projects that have begun. So permits typically precede starts, giving us a glimpse into future construction activity. The trend is clearly visible on this chart. The monthly data for both of these series is highly volatile, but if we zoom out to just look at the overall trend, we can see that both housing starts and building permits have slowed over the past few years. Elevated interest rates have increased borrowing costs for builders, which can deter new construction. This leads to fewer building permits being issued and thus fewer housing starts. Now let's move on to builder confidence, which is measured by the NAHB Housing Market Index. A higher reading indicates greater confidence, which often translates to more construction activity. While we've seen some spikes in confidence over the past couple of years, the index has spent most of its time below 50, indicating a negative outlook. The NAHB index is influenced by builder perception of current sales, buyer traffic, and future sales expectations. From previous charts in this video, we know that current sales are not the strongest, and buyers have been sidelined by elevated rates. Well, since rates are still elevated, affordability issues don't seem to be going anywhere anytime soon. Builders borrowing the material costs are impacted by the high interest rates as well as the uncertainty surrounding tariffs. And for our last chart, let's talk about home prices. The S&P CoreLogic Case-Shiller Home Price Index is a leading measure of home price changes. U.S. home prices have risen for nearly 2 years straight, although home prices are beginning to stall in different geographical markets. Typically, rising interest rates reduce buyer affordability, decreasing demand for homes. This can lead to downward pressure on home prices. But what makes today's housing market different is that we're seeing elevated mortgage rates in conjunction with elevated home prices. The lack of existing homes, the slow growth in new homes, and construction weakness has led to limited inventory, which then it ultimately just boils down to basic economics. When demand exceeds supply, prices rise, even in the face of affordability challenges. So what does all this mean for the broader economy? The story we've seen today isn't just about the housing market. It's a critical reflection of overall economic health. So what does all this mean for the broader economy? The story we've seen today isn't just about the housing market. It's a critical reflection of overall economic health. So what does all this mean for the broader economy? The story we've seen today isn't just about the housing market. It's a critical reflection of overall economic health. Housing is a major driver of economic activity, impacting everything from consumer spending and job creation to the performance of related industries. The persistent affordability challenges we've discussed, driven by elevated mortgage rates and limited supply, have the potential to dampen economic growth. The slowdown in housing construction, for example, directly impacts employment and the demand for building materials. Similarly, reduced home sales can lead to decreased spending on home-related goods and services. As we look ahead, the housing market's performance will be a crucial indicator of the economy's resilience and potential for growth. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.
Stuck in the same patterns and routines? Trying to take your practice to the next level? You need to register for the Exchange Conference. In March 2025, industry experts will be gathering in Las Vegas to share actionable information, network, and learn the latest innovations in practice management. Invest in your greatest asset, yourself, by registering at exchangeetf.com today.